I will leave you with one parting note. Taking the normal route will set you up for a normal life.
Hey guys, welcome back to the 1% Better podcast. I'm joined today by Jacob. We're going to get into entrepreneurship, trading, markets, AI, all that stuff. So I'm going to toss it over to him to give a quick intro and we'll get started.
Hey, yeah. So what's up, guys? It's an absolute pleasure to be here with Matt, and couldn't be more fortunate. And just kind of wanted to give a brief introduction on myself. I've kind of always had that entrepreneurial mindset of always wanting to learn and do more. And quite frankly, the first thing I had been doing was reselling shoes off the drop in 8th grade. And it's funny because I grew up in such an entitled area, and that entitlement and being surrounded by it really is what drove me to better myself and learn all these different ways to, in lack of better words, make a living for myself, whether it be a little bit here, a little bit there, a little bit there. It's all about diversification and ensuring that you've budgeted for everything you need and are good to go.
Yeah. Would love to kind of dive into that a little bit more. So obviously you mentioned you kind of grew up always having that entrepreneurial mindset. How has that translated into more of your adult life and some lessons that you've learned along the way?
So it has most definitely transitioned into my adult life. As my senior year going into my freshman year in college, I had actually started a few different LLCs, primarily running drop shipping business models and solely advertising on Facebook and learning the Instagram algorithm inside and out, and did really well with it. And kind of COVID hit then, simultaneously as I was working as an event organizer for Dream Hospitality Group and Tao Group in the city. So I had to learn to pivot really quickly, as I had maybe 200 plus orders that I either could not ship out or where shipping was just simply unavailable. So I had to quickly strategize a way to simultaneously please all these customers who had placed orders overnight that I couldn't fill, and at the same time find another way to make money for myself. And that's where I pivoted more towards the markets and simply closed out the LLCs and ensured that every customer left happy and fulfilled, and kind of got a little lucky on the timing there, because put a lot of money in some long-term safe holds right at the bottom of the COVID crash, and that's kind of enabled me to scale and pivot to more complex trading styles.
Yeah, it seems like a lot of people, started their trading journey in COVID. Everyone was sent home. The markets kind of dumped very briefly. With all the stimulus that came in, they rebounded pretty sharply, and a lot of people started putting that extra stimulus money into the market, making some bets. Can you kind of walk through, how you evolved as a trader? So obviously, you had your drop shipping businesses. You eventually closed those out during COVID. You switched to the markets. Where did you start trading? Like, how did you get involved? What were some of the first places you learned how to trade?
Most definitely, and this is where I'm very fortunate to come from the family that I do, and to have had a grandfather who preached investing from a young age. So I was probably one of the first people with the Robinhood app, and I remember my friends in college telling me that it was a scam when it first came out, and I've been trading, or better put, investing in the markets since I was 18. So I had already kind of had that fundamental understanding of how markets worked, and knew of and somewhat about the dot-com bubble, the '08 crash, and really when COVID hit is when I did a deep dive on what caused those, what legislation was in place. And as everyone kind of came into the markets as we saw with GameStop, I was working at the time, or I was interning at the time at the Securities Industry and Financial Markets Association, and it was actually shocking to see what was thought of the retail investor. They thought that the retail investor was just not smart, didn't know what they were doing, and at the time, tossing money into zero-date options, which is most definitely the option I would recommend to stay away from as a beginner. If you are getting into the markets, I would highly, highly recommend looking into Bloomberg's courses, maybe getting Bloomberg certified, just so you have a somewhat fundamental understanding of how bonds and currencies and all of these different factors play into the stock markets, because of what often gets misconstrued is that the stock market is not an accurate depiction of the economy, because we still have a slightly inverted yield curve, and lo and behold, up until just recently, 7 singular stocks and, in my opinion, AI hype had been driving the S&P 500.
Yeah.
It's kind of wild to think about.
Yeah. We'll jump into the macro landscape a little bit later. But so obviously you said so did you have a background? Did you study finance in college? Is that kind of what you were studying?
Yeah, so I'm a double major in finance and marketing.
Okay, cool. How did that, if at all, how did that education play into your time as like entering trading, or was it not really as useful because it wasn't focused on that as much?
Well, there are definitely very, very useful bits, such as any corporate finance class that you quite literally have to know have to know how to run discount cash flow models and forward cash flow models. But now, with AI, if you have an understanding of what a weighted average calculation is, you've just leveraged AI to be able to fill in that gap in the knowledge. And it's kind of wild, because it's genuinely sad to say that I use very, very little of what I've learned in school in what I do in the real world. I've worked in marketing, I've worked in finance, investment banking, and corporate credit, and I can maybe name 4 or 5 things that I learned throughout college.
Yeah, I think that's a pretty consistent trend, especially in the age that we live in now, with the access to the internet, now with AI making that even more fast in terms of efficiency, and how quick you can go from like brainstorming a topic to understanding some of it to a deeper level. I definitely have friends and family who share the same sentiment that, you really learn most of what you learn like on the job out of college or through your own due diligence. I think that that's kind of what's coming to a head is, previously you needed to go to college because that was the premier place to get information maybe at that higher level. But, with the access to the internet, there's a ton of, as you mentioned, like Bloomberg certifications. There's all these different, asynchronous ways of learning that's just more effective than maybe, traditional degrees for certain fields, not for everything. You want to be doctor, lawyer, engineer, you definitely have to go to college.
Definitely.
Yeah, but for other, especially creative industries, I think, or entrepreneurship, you can learn so much more by your own due diligence and just getting the reps in yourself, interning places, working for other people. I would like to hear, your take on stepping in as a trader early on, maybe some advice you would have for people who are just starting.
Most definitely. I think so many people get caught up in the quick profits. They see the screenshots maybe of someone posting a $50,000 profit in a day, and that's jumping right into options. And the first thing I would recommend before even looking at options is simply just understanding the underlying movements of company stock prices. because if you can't, if you don't know how to fundamentally value a company, how can you really can't trade in the markets with any sort of rationale or logic behind any trades you place, because they're all going to be gambles at the end of the day. So I would highly, highly recommend simply just maybe picking 5 stocks that you feel as if are comfortable investments, even just maybe putting $50 in Robinhood just to get your feet wet, or open up a paper trading account before you start touching options and really trading them with real money, because I can tell you it is just as easy to lose that 50,000, if not easier to lose that 50,000 than it is to make it.
Yeah.
And that's the sad part.
Yeah, I definitely agree. I think COVID brought out a lot of those internet personalities posting, the day trading clips and those huge profit P&L losses. I think what's maybe something we can highlight for the audience, like obviously, is the difference between investing and trading. And I think something else that sometimes gets twisted is there seems to be, like, between traders and investors, there seems to be this like battle over fundamental versus technical, where some people say, oh, it's only the technicals matter, or oh, only the fundamentals matter. I mean, I personally think that it's just a combination of both, and then the macro. I mean, at the end of the day, the markets are psychology. But I would love to kind of hear your take on that. Any learnings you have about that?
Frankly, I could not have said it better myself, as I'm a big charting guy. I'm right on TradingView, Jacob Osiason 7, same handle, but I think it's a combination of them both, and I think you can do both, as I do both, but I most certainly wouldn't recommend jumping into doing both as a beginner. But once you progress and can kind of feel out the markets a bit, for example, I have a separate portfolio of simply just shareholdings, and then I have my options portfolio where I'll play different types of spreads, leaps, different sorts of multi-leg strategies to mitigate risk and remain consistent and organized, frankly.
Yeah. I definitely think, and what you said before about, how easy it is to lose the 50,000, I think it's important for people to realize that, one, you having those two separate portfolios is probably a better option, where you do have longer term holds. And listen, if you want to trade, go for it, but it has to be with money that you're comfortable losing, because most likely, one of the best pieces of advice I heard when I first got into trading was if you fund your account with $2,000, expect that to be a $2,000 course. You're probably going to lose it, but you're probably going to learn a lot of things over the course of that. So the next time you want to re-up your account, you have a much better perspective of how to approach the market. So maybe we can kind of dive into that, what your approach has been. I know you just mentioned you have 2 different portfolios, one's with options, you're into charting, but maybe, flesh out how you approach it for the audience.
Most definitely. So I definitely play a variety of strategies. I play a somewhat modified version of the wheel strategy, which is, in my opinion, the safest option strategy you can play. Because the way I look at it is, whenever you sell to open a put, you're picking a strike price on a certain stock. Let's take Apple, for example. Let's say Apple's trading at $100 a share, and if you sell put on Apple at a $50 strike, if Apple falls below $50 and you get assigned 100 shares of Apple at $50 a share, in my opinion, that's a pretty good price. So I see that as kind of a win-win, because I can sell puts and collect the premium every week, which can be in the thousands of dollars if you're playing it on stocks with higher intrinsic volatilities, deltas, and this is where all the Greeks come into play. But essentially sell puts to buy shares to write covered calls, because that's how the wheel keeps going. If you by selling puts, say the market's hit a downturn, you're assigned 100 shares, but it's a stock that you want to buy. You're assigned the 100 shares at a price you want to buy that stock at, and you get to keep the premium. And then you could sell calls against those shares, keeping the premium until those shares get called away into profits, and rinse and repeat every week. It only takes a bit of time to really build up a portfolio doing that, because you need a significant amount of capital to start out with, but I've seen people do it from $1,000 account and scale it all the way to $30,000, and all it comes down to is the individual's mindset. If they're that driven and willing to learn and put their 100% in, they're going to get the most out of it, and those are the people that we'll see at the top.
Yeah. And I think, and correct me if I'm wrong, but what you're talking about is mainly like if you have an existing portfolio and then you're selling the options against whatever securities you own to kind of collect the premium, get the income, profit from the volatility in the short term, but you still have the long-term hold.
Most definitely.
Okay.
Exactly correct.
Yeah. Yeah. So for everyone listening, definitely second that. That probably takes, it takes initial startup capital, but that's probably the more popular like income generating way, instead of just like the classic day trading or what you might see using like margin accounts. Options is slightly different. It still gives you some financial leverage, but a little bit different than margin trading.
And aside from that, I really primarily only play debit spreads, because by playing a debit spread, you're buying to open a lower price call while simultaneously selling to open a higher price call, and that could be vice versa with puts as well. But by selling that higher price call, what that does is it gives you downside protection should the underlying stock not move in your favor. So I always try and play some sort of option that has a mitigating risk factor on it, some sort of hedge factor.
Yeah.
And that's what helps keep it consistent, because consistency is the name of the game in the markets.
Yeah. I think that's another important point about like risk management, which I think, again, a lot of these like day trading personalities, they rarely ever talk about it, or if they do, it's not, at the forefront of what they're mentioning. But at the end of the day, like your goal is profit, but it's also capital preservation, because it's just not possible to have up only years, right? Like, if you look up any chart of top hedge fund managers, most of them don't even beat the S&P like on a yearly basis, right? Only the top performing ones are able to do that, and that's because of risk management and the consistency that you're talking about. And listen, like if you have a down year, at least if you're hedged, to be able, maybe not profit from it, but mitigate your downside based on whatever strategy you want to go with. But you don't want to be risking your account on any one trade or a couple of trades. You want to be, one, diversified, but two, also placing the amounts that you think are a smart bet compared to what your total capital allocation is, right? Would you agree with that?
100%, and piggybacking off of exactly what you just said, exactly being properly positioned and leaving a margin of safety of cash. I would always recommend that to anyone in the markets, even if you have 10, 20 years of experience. You always leave a margin of safety, because you never know.
Yeah.
And I'm a big believer in that, and big believer in Buffett. one of my go-to investors, and frankly really respect his approach to investing. And I always think back to that quote of when I forget what news outlet it was, but when him and Jeff Bezos were having a conversation, and Bezos is so simple, why don't people just copy it? And Buffett just goes, because nobody wants to get rich slow.
Yep. Yeah. I think that brings up two good points. One that kind of plays on the site, how much psychology is involved in markets, which I want to dive into in a minute. But before we go there, ironically, like, and I'm sure you're aware of this, but I believe it was last quarter, Berkshire Hathaway, which is the company that Warren Buffett runs. I'm pretty sure they hit an all-time high of cash. They sold out, right? I believe that they just hit, which then, of course, is then this quarter has been a bit down. But would like to kind of hear, because I feel like everyone got very exuberant with the huge run-up we saw this year. The markets rebounded off November lows of 2022, and I mean, this year was basically up only, and as you mentioned, it was highly concentrated in about 7 names, but it still was a pretty up market for most of 2023 up until the past 2 months. Would kind of like to hear your take on that.
And it's so funny that you bring this up, because quite frankly, I've felt as if it's been in an uptrend ever since we've gotten out of the initial COVID crash. If you look at it, it's being the S&P 500. If you look at the SPY, every day it's trading under its average volume. Mm-hmm. So it's really institutions and big order blocks going in that are dictating the price action that we're seeing, and that's kind of why we're seeing the S&P trade in the sideways channel we are. Because if you look at the volume, it has an average daily volume of 78.9 million, but yet it's trading at 10 every single day. And that says to me, what's going on here? And let's get to the bottom of it, because it points out either an inefficiency that needs to be, or an efficiency to hop on the bandwagon.
Yeah. So, going off that, I would love to kind of jump into the psychology of the markets. You had a pretty great line at the beginning of this where you were talking about that everyone thinks the market is like an accurate indicator of the economy, but that's not really what it is. And I agree with that. I think and I'm not sure if Buffett said this or someone else, but I just remember hearing someone saying that the market is just the collective of human psychology at this given point in time, like whether it's within your country, if you're talking domestic stocks, or globally, which I think is a pretty fair assumption, because I think something that people misconstrue about trading is that, like, there's a buyer and seller for every trade, right? Like, I think people, especially when you're maybe more retail or trading on a smaller account, you don't think your trade sizes are so small that, like, they may feel insignificant, but like, there is someone on the other side of that trade, right? You're not just selling into the ether, right? Like, someone thinks it's a better time to be on the counter end of your trade, and when you have that perspective, I think it highlights just how psychological it all is, because again, it's just buyers and sellers, bidders, takers, just getting together and trying to find what the equilibrium price is. So would like to kind of jump into that with you, get your thoughts on that.
Most definitely. And that's where if you're trading any sort of option, and frankly, even investing, I would go so far as to say this: the market has no room for your emotions, nor does it care, nor will it stop to skip a beat whatsoever. The markets are, frankly, a place where I try and still struggle with this, in the sense of when I trade and have a really bad day, because I can also, piggybacking off what you said earlier, tell you for a fact that I've lost tens of thousands of dollars in a day. It's frankly almost easier to lose money trading options than it is to make money, and that's what gets misconstrued so often. But in addition to that, you have, in my opinion, the sheer amount of structural unemployment in the economy. If you think about it, you have all of these Wall Street bankers and these hedge fund analysts that had been tenured at all these big banks that never got rehired, and instead got replaced by interns and not freelance employees, but either contract employees. And exactly what Powell said at Jackson Hole was that we will need to see a job market slowdown, because if you look at the yield curve, it's still inverted, but here we are and the markets are green. And that's where the markets are not an accurate depiction of the economy, because they do not take into account all aspects of the American economy. If you look at the housing sector, when you go and buy a house, you're not just going to buy a house, you're buying a house, you're buying furniture, which entails spending in the consumer staples sector, and you need to then go and buy appliances for that house. So you're then tapping into electricity stocks, and it really is an all-encompassing picture of, in my opinion, U.S. spending. And you can see that as credit card debt continues to get higher and higher and higher, as did the markets. And it's exactly piggybacking off of, again, your point, the fiscal stimulus that was introduced, because during COVID, we had interest rates at zero across the board, the Fed buying debt off companies, providing liquidity to the markets, which kind of created this recipe for the scenario that we're currently seeing.
Yeah. You brought up a lot of great things there, so I guess we can really I would love to dive into just current macro state. So one of the things that I thought has been kind of flying under the radar, maybe it's not, but I just, at least the circles I run in, I'm not seeing it talked about much, and I think it's kind of the most concerning data point we've gotten recently, is the consumer credit you just talked about. I mean, in Q2, I think it reached over $1 trillion for the first time in history, and now it's supposed to add another $10 billion to that going into this quarter, Q3. And at the same time, we have interest rates climbing, holding steady for now, but I mean, the Fed isn't going to pivot anytime soon, I don't think, at least. Or at least they're going to hold it, right? I don't think we're seeing cuts until at least, next year. And at the same time, the market's also going up. So normally it's supposed to be the opposite. If interest rates are going up, the market's not supposed to be going up with it, right? We obviously saw the initial correction last year, but so we have a credit crunch on the come up, because consumers are tight right now, I think, in terms of available cash, which is why I think trading volume is down significantly. We have credit hitting all-time highs. We have corporate debt maturing this year is hitting an all-time high, and a lot of it can't be covered. Delinquencies just crossed over the highest rates they've had in history, I believe, at least at regional banks.
Yes, definitely they did.
Yeah, and all the while, everything is just up and to the right still. Again, barring the last few months, but still. So obviously, the stock market's not a depiction, because with all that being said, it shouldn't be going up if all these data points are coming in. To your point, Powell's comment, I think, is what is going to be the key determinant going forward, is, are jobs going to cool? Because if jobs don't cool, it doesn't, inflation just has a higher chance of ticking back up. But we'd kind of love to hear your take on, I know I just threw a lot, but that's kind of everything I'm looking at.
Most definitely. I'm a big macroeconomics guy. That was one of my favorite classes in college, and I will always thank Mr. Wittershine for this, because there is no such thing as a free lunch.
No, there's not.
Period. And it's where that intelligence gap is forming that you've seen me kind of highlight on my threads, is that all the noise and all of the worry and, or better put, FUD, fear, doubt, uncertainty, is leading to all this noise surrounding a recession, but yet we're in a recession. The yield curve has been inverted. So let's put that aside for a minute and take this piece by piece, because we are in a recession. The yield curve is inverted, and that is, by definition, a recession.
Yeah.
And we also currently are seeing geopolitical turmoils rise between the U.S. and China, and as well as Russia and several other countries. And I think that'll be a big factor weighing on the markets, especially pertaining to the AI sector and renewable energy sector, highlighting the importance of supply chains and all the necessary minerals that we get from other countries for electric vehicles. And with the current trade war that we're seeing, it could be quite some time for some new foreign policy to be introduced and for things to actually settle down in that space, as I do not see it settling down anytime soon, unfortunately.
Yeah. So obviously, like I think most recently you worked as a credit analyst. So do you have any insights into what we were just talking about in terms of credit, corporate debt maturing? Well, what were you seeing there, and what are you looking for going forward as more signal?
So prior to actually working as a corporate credit analyst, I was working for the Securities Industry and Financial Markets Association, SIFMA, mouthful. But I was primarily on their capital markets team, sitting in on Reuters roundtables and different House Senate Banking Committee hearings. And I actually was working on the legislation on Section 13F, the Exchange Act, which put in place all of these requirements for banks and their stress tests and the amount of capital on hand that's needed, that was done away with under the previous administration, which led to the bank run that we saw in Silicon Valley. And at this point, I can't remember which comes first. If it's Silicon Valley, First Republic, then what was the last? I'm blanking on the last one, but it's quite literally wild to see that a third of these banks failed their stress tests and had to redo them, including banks like Columbia, like Valley Bank. Your big, relatively household names are failing their stress tests with the SEC, and it's shocking. And that's, in my opinion, why we saw Fitch come out with a downgrade on the U.S. for the first time in my lifetime, at least, as a bare minimum.
Yeah. And that reminds me, are you familiar with the All In Pod? With Tremont, David Sachs, David Freeberg. Okay.
Don't believe so.
Yeah. You should check it out because, they talk a lot of macro. They're like $4 billionaire investors. But they did an episode when, SVB, Silicon Valley Bank, failed and the First Republic. I'm also blanking on what the last one was too. But and they were talking about how, one, like, people just don't know what they're actually signing up for when you get a bank account, right? Like you just mentioned also, a lot of people didn't realize that during COVID, they changed the rule, which previously was that they had to have 10% of deposits in reserves. They lowered it to 0 during COVID for anyone who wasn't aware. So basically your bank had to have 0% reserves. So just think about that for a second. But they were talking about how, most people don't realize that you're giving your money to a bank and then they're doing something with it. That money just doesn't sit, right? Like they don't, that's not what your money does. That's what people think. And frankly, that's probably what a lot of people want, but that's not the reality. And something that they talked about that I thought was pretty interesting, especially for like business banks, because that's the reason SVB was so big, is that so many VC firms and startups out there used it as their commercial account, their commercial business bank. And they were saying how maybe, a way forward is to just have two different types of banks. One that's the banks that we know now, which is, you're technically a depositor to the bank and, they owe you money. But there could be a world in which maybe instead of having just all free banking, open up banks that are truly banks. You put the money in, you pay them a fee, but that money gets vaulted and it's there. Like, it doesn't move. They're not putting it in bond. It's not going anywhere. Just to, that could be a potential solution, because obviously, as you just mentioned, between the Fitch downgrade and the collapses we saw, they can't survive stress tests. And I don't think anyone in 2023 would think that some of those banks that we just mentioned would ever fail. So, and for those, maybe if you want to flesh this out too, Jacob, and for anyone who doesn't know why they failed, part of the reason SVB failed was when you're holding long-term treasuries, as interest rates go up, the actual underlying value of that goes down. And for whatever reason, they don't have to actually mark it. Like, it's paper marked, I believe, right? So the failure there was that, the failure there was that basically on paper, the last time that they were checked in on, it was fine. But then when they actually had to realize the losses, like, that's when everything kind of went downhill. But yeah, would love to kind of get your take on that.
Yeah, frankly, and this is where I quite literally, don't know how this person was in the position he was, because you had the former I believe it was the chief financial officer or chief associate officer of Lehman Brothers as the CFO of Silicon Valley. And it has to raise the question of, how do these same people keep getting back into the positions of power where this can happen? Because you hit the nail right on the head, is in the sense that it was just poor management, because they were sitting on so much unrealized debt of long-term treasury securities. And when they finally realized it by either selling or buying it and getting a big ring from a margin calling, that's where we saw the bank run that we did. And I think that we're likely going to see some legislation come into place that will increase the, the kind of requirements for banks, because the SEC is not playing games at all now. I don't think they ever were, and especially they're not now.
Yeah.
Because they've also gotten themselves in a relatively tricky predicament, if you were to ask me. Because in my opinion, raising rates at this point, they're already so high that you're just raising them even that much further, which doesn't even have anything to do with the job, which has very minimal to do with the job market. And that's what really needs to cool down.
Yeah. And I think that brings up another good point, is that, the ironic part is that, I mean, this has been said a million times, but it's almost like the Fed doesn't listen to their own advice, but it takes usually like 18 months to see a hike cycle play out, right? And we're basically almost at 18 months from when we started the hike cycle. So in reality, they hiked aggressively, which is fine, whatever. They probably needed to cool inflation. But if they continue to hike, they're not even giving it time to play out. I mean, as you just mentioned, for it to hit the job market, you need to see it work through all the other places in the system. It needs to affect the business's profit margins. We're having record earnings still. It's the job market's not going to cool if we're having record earnings. But come next year, we might not have record earnings if this hike cycle actually plays out then. And we can segue this into the real estate market, because I know you have some familiarity there too. But the other big thing is that, the U.S. housing market hasn't moved at all. And you're seeing Europe's crash because they don't have fixed rate mortgages like we do. We're one of the few countries that does. And so you have a surplus of people who, leading up until before COVID, and then including COVID, they locked in mortgage rates at below 3%. I think it's like 70% of homeowners have a mortgage rate under like 4%, and then it's like an insane amount have a mortgage under 2% because of COVID. And then you're looking at people who want to buy homes now, and they're staring down the barrel of 8% mortgages, 7.5%, 8% mortgages. Those people are not going to sell into 8% mortgages. It's not going to happen. And unless people are selling homes, the prices aren't going to come down, right? So the only way that gets fixed is, one, you have a crash eventually, or two, there's enough new supply coming in that we can lower prices. But that's going to, again, it takes time. And the housing market is one of the most sensitive industries to rate hikes. So yeah, we'd kind of love to hear your thoughts on that, what you're thinking.
The housing market, I actually would say, is a very good depiction of where money is being spent in the economy, as I was saying earlier. But I would also go as far as to say is that it's shocking to see in a Bloomberg headline that it is cheaper to rent on a monthly basis a house in the entire United States, aside from 4 major cities, is mind-boggling, because that is so wrong. And it goes back to the artificial stimulus introduced by the government, and it is the same thing that's going on now with education. Is you have kind of the government, in lack of better words, toying with people in college, promising student loan forgiveness, then pulling it back. That just doesn't sit right with me, and brings me right back to my point of why should someone have to pay to learn? With the increase in accessibility to information, thankfully primarily due to AI, you do not need to pay that $200,000 for that piece of paper to go to Harvard to be successful, to learn. And frankly, I think it's an injustice that you have to pay to learn at all, because knowledge is power, and information should be shared and spread. And again, I would say more information isn't necessarily more informed. It's where you have to really do your own due diligence and filter through all that information to find the bit that is important.
Yeah. I definitely agree. I mean, my dad's going to hate me for saying this, so sorry in advance, Dad. But, I mean, YouTube has probably taught me more than the 4 years of college. Like, you know, I mean, granted, I was on YouTube longer than I was in college, but, like, and that's free. You know, YouTube is free. Other than your attention for the ads, like, it's effectively free education. And this was before AI. Now with AI, it's even faster. Granted, there are some concerns about like accuracy, but for the most part, an individual's ability to acquire new information has exponentially increased, and probably will only exponentially increase. And at the same time, society has only progressed, which means that we've only gotten more efficient at what we do, and somehow college education has only increased with basically zero improvement, I think, at least in effectiveness. I mean, I don't really know how you would measure that, but every year tuition goes up. Granted, inflation, of course, like, yes, costs go up, but not to the tune of what they've gone up. And if you look at what college cost 20 years ago versus now, and the starting salary out of college 20 years ago versus now, it paints a very different story. You know, my uncle, who's, you know, in his late 50s, went to med school for like less than $10,000 a year, maybe $10,000 a year. And now, you know, you're looking at some schools are like 80, 90, 100 grand a year for med school. And doctor salaries haven't increased 10x since 20, 30 years ago. So
they frankly declined since 20, 30 years ago.
Yeah.
And it's exactly where that inefficiency is because you're spending hundreds of thousands of dollars, and my dad will hate me for this one too. My dad's a doctor, but he is, quite frankly, when we've just been talking with each other, he said he wouldn't have, if he was in college now, he probably wouldn't have gone the medicine route because it entails 4 years of your traditional college, a 3-year residency, just to not be making as much when you can finally become a doctor.
Yep.
And you become a doctor and you're already in hundreds of thousands of dollars in debt. And that just shows to me that the system is broken. Yeah. Because that should not happen. It should not be the case.
Yeah. I totally agree. I mean, listen, again, if you want to be a doctor, go for it. We're not trying to advocate you shouldn't be a doctor.
Absolutely.
we
need our doctors, and we appreciate you.
The world needs doctors, we need engineers, we need lawyers. But for those of you who are maybe considering other paths, there's probably never been a better time to reconsider that type of commitment. Or if you do want to go to college, then again, maybe just don't consider one that's going to put you into $120,000 worth of debt. 40 years ago you couldn't make 10 grand a month on YouTube, but now you can. So and that's just one case, one example. And I mean, I had the episode I did before this, which went live last week. I talked with one of my friends from Forbes and just in life in general. And, we talked about how both of us have landed jobs based on personal projects we did that had nothing to do with our formal education. It was experience that we got ourselves through self-acquired skills and self-started projects that maybe didn't make us money, but they gave us experience and a skill acquisition that we didn't get in college. And that's what I spent an interview talking about, not my college degree. So, that is the reality. Whether people want to admit it or not, I know I have a lot of family members that might not believe that or understand it, but I mean, it is the truth.
And I couldn't agree more, and it goes hand in hand with my mantra, and what I live by is that if you're doing what you love on an everyday basis, and you can genuinely say to yourself that, I love what I do, because it does in turn reflect in the work that you do. And regardless of the field that it is, whether it's being a teacher, being a doctor, being a stock trader, being a YouTuber, you're going to be successful in that career regardless of the field, because you're going to be adding value. And that's what it comes down to. And because you have that passion, you're going to go far, because it just naturally will come. And I think that's what so many people miss as well, is that younger generations have options now. Mm-hmm. They don't have to go the beaten arrow path of going to a traditional 4-year college and getting their MBA after working for a few years and going back to work 9 to 5. Whereas now, as we saw with Dogecoin and those pump and dumps, just like we did with NFTs, people were selling NFTs of the Nyan Cat for $500,000.
Yeah. Yeah.
And there are a lot more ways to make money, in my opinion, these days than there were previously, in large part due to just technology innovation in itself.
Yeah. No, I mean, I couldn't have said that better myself. There are just more options. You have more avenues. There's more options. And, if you're someone who's wondering, how do you get started, just start learning something or anything. I mean, you can go any route, as what we just said, but it's out there. I mean, I always just start on Google. You can just start on YouTube, but just type in how do I do X, or how do I, work X? Just figure out what you want to do by doing it is kind of how I live my life. Just putting in the reps and trying things is, to me, the only way you're actually going to know what you want to do. I mean, I've gotten to a point in my life where I love what I do. I don't care if it's Monday or Saturday or Friday or Sunday. Every day to me is exciting. I don't dread my work week. But to get here, I went through 2 jobs. I graduated college in 2021, left my first job after 9 months, left my second job after 6 months, and then landed where I am now, and I love it. And I had plenty of people along the way tell me, you're crazy, you can't leave a job after only 9 months, or you're on your second job in a year, you shouldn't be doing that. But if I listened to any of them, I wouldn't wound up where I am. So, I'm a huge believer in questioning the traditional path and kind of making it on your own. So Yeah.
It's too funny because I think the same in that same mindset is frankly challenging the traditional beat narrow path, because exactly like you said, if I were to have taken that and taken all of that advice that I've gotten, which has been the exact same, and I would even go so far as to say that the college I went to quite literally told me to remove several of my LLCs from my resume because it wasn't relevant work experience, the career center told me. And I said to myself, great. And that's me. That was when I was running SEO models with various different websites all at once, scaling them into doing six figures in e-commerce sales. And it's mind-boggling to think that a school would tell someone that. And not for nothing, I was really discouraged by it at the time. But if I'd listened and if I'd quit, I wouldn't be where I am today.
Yeah. Yeah. And I think that highlights, again, something important is that, if you're asking for advice, one, don't ask from it from someone who isn't where you want to be, and definitely don't listen to it if they're not where you want to be. And I think that's, there are best practices for resume, but, obviously that was pretty relevant work experience. If as a kid in college you're doing that, I mean, an employer would be pretty impressed with that. So, if there's anything you've done on your own, it's probably worth showing rather than hiding. So I could definitely agree with that.
Great. And that's where I would say the same exact thing is let the world hear you. Let them hear what you want to do, your voice.
Yep.
Because at the end of the day, if your voice isn't heard, it goes unnoticed.
No one's going to speak for you, Yeah.
Mm-hmm.
And I mean, I think the other piece of it is, like, do it in public also. Like, I just interviewed someone last night, and she was really harping on, like, building in public, and I couldn't agree more. I mean, I wouldn't have met you if I wasn't building in public. I wouldn't have met a million other people. I wouldn't, I've gotten several opportunities through just posting online and doing this podcast. Like, the only thing I can guarantee you, and I say this with 100% certainty, is that if you don't post online, you will miss opportunities, right? I can't guarantee you're going to get opportunities if you post online, but if you don't post online, you're 100% not going to get them, right?
Because there's always the hidden opportunity cost.
Yeah, exactly. So, yeah, if there's anything else we can teach you from this episode, it's build in public, build online, and just talk to people. Just because you're not talking to them in person doesn't mean you're not talking to someone, right? Which is another thing that I think the older generation just doesn't understand, is that they always harp on us being on our phones, social media, blah, blah, blah. Yeah, of course there's negatives to it. Yes, you should touch grass. Like, I agree with all those things, but, like, you can have very real conversations online. So don't shy away.
I could not agree more.
Yeah.
I couldn't agree more, because it's exactly what frustrates me so much almost every day is people in that fixed mindset, which one in itself is that fixed mindset limits achievement. Because if you're in that fixed mindset, you're not thinking of all the other possibilities. You're just tunnel visioned into whatever you're doing. But it's where, quite literally, like my parents' generation, if they wanted to go read a book like Rich Dad, Poor Dad, they had to walk all the way down to the library, which maybe had it. And our generation, whereas, has it at their fingertips. And where the information is there, and it just comes down to the individual's willingness to learn and their drive and how badly they want it.
Yeah. Again, I definitely agree with all of that. And I mean, just like thinking about how fortunate that is, what you just highlighted is, like, you don't have to even question if the information is available. Like, it's there. Instantaneously, it's available at your fingertips. It's just up to you to actually exercise it. But I would also like to kind of jump into what is your maybe advice for people who are kind of struggling to maybe take that step into entrepreneurship? Obviously, that's kind of been your mindset from the beginning. And we just touched on a lot about what has changed over the few years. So maybe what would be some of your advice to someone who's looking to start but maybe hasn't taken that first step yet?
I would say take those risks now while you're young. When you're young and in your young 20s is the time where you can take those risks and have time to recover from them, first and foremost. But also, there's no point in my opinion at least, in working in any profession if you're not happy. At the end of the day, if you're not happy, surrounded by the people you love and surrounded by people who care about you, what's it worth? I can say the exact same as you, as I've worked in various settings that I did not enjoy in the past. And if someone tells you that, like they told me, to take it off my resume, don't listen. Take those risks, take action, and take the leap of faith, because that's the only way you're going to find out.
Yeah. Yeah, I second everything you just said there. I think that timing is one aspect of it. Fortunately, the younger you are, the easier it is to take risks. And if you're not aware of that, now you are. Because I think a lot of people sometimes wait, or they're like, I want to maybe have something as a backup plan, which, that's fine if you want to have like something, but don't spend too much time on that, because if you really do, you have a window right now where you probably have the least amount of responsibilities you will have. As you get older, theoretically, your financial responsibilities and just life responsibilities should increase to a degree. So the younger you are, the more freedom you have to explore these different avenues. And I really want to second that piece about working a job that doesn't make you happy just for the sake of it. I don't care how lucrative it is. I think anyone will tell you who has money that money only solves money problems, right? It won't fix your bad relationships. It won't fix your unhappiness. It won't fix your bad habits. It might make it easier because you don't have the financial stress, or you can shortcut certain things by paying for effective treatments, whatever. But it will not fix it in and of itself. And listen, I get it. Like, I want to have a lot of money. I don't think anyone doesn't want to have a lot of money, but at the end of the day, if you're not waking up excited for the day, it's just, think about doing that. And it's hard when we're young, right? How old are you?
24.
Okay, same age. Okay. Yeah, so both of us being 24, it's hard for us to think about what doing something for 20 years looks like, because we've only been alive for that, like about that much time. But try to envision what it's like to wake up for 20 years straight, 5 days of the week, doing something that you hate just for a fat paycheck, when maybe right now you're not going to make the fat paycheck, but 5 years from now you wind up in something you really enjoy, and then you can really start expanding into that. So
I frankly could not have said that better myself, and what you were just saying at the end really just caught my eye, because I feel as if so many people get caught up in that short-term gratification and then find themselves year or two down the road and are sitting there pondering where time went, because at the end of the day, there is only one commodity in life that you cannot buy more of, and that is time.
Yep. That's another great point, which is, as you just mentioned, like I think the way I think about careers a lot and salaries is opportunity cost as well. Because it might be great to work at JP Morgan and pull in $250K, but if you're working a 100-hour week, like one, you're getting paid basically minimum wage at that point. And two, like what is your quality of life outside of work? Especially, listen, if you love it, different. Like, that's like, kudos to you, great for you. But if you're doing it just for the money, again, you can only do that for so long. And like you just said, you can't get your time back. And I think that that's something that just doesn't get talked about enough. But
It most certainly doesn't. And being one that has made that mistake of taking a job simply for the paycheck, it's not worth it.
yeah,
It's not.
yeah. And I mean, to go off of what you were saying before, like about risk, because this just popped in my head, but like even monetary risk, like I've lost thousands of dollars on failed ventures, trades, like, and yeah, it sucked at the time, but 3 years from now, I'm really not going to care about it. And like every single failure I had up until this point led me to where I am now. And the more time you spend being afraid of failure, the longer you're delaying yourself from getting where you probably want to be. So that's just kind of how I look at it.
I love that. I don't know if that was a quote or if you just spit that off the tip of your tongue, but that was. I love that because it goes hand in hand with everything that I live by, and it's you just got to seize the moment. And where I would say exactly like you were saying earlier, having that quote unquote not in real life engagement with another person, whether it be online or through social media, it still is a form of mentorship if you need it. You could go on YouTube and there's a million people who are offering free courses or fairly cheap courses in anything that you may want to learn, and where quite figuratively and literally speaking, the information's at your fingertips.
Yeah.
If you really want it.
Yeah. Well, this has been great. I want to open up the last few minutes to you. Is there anything that you want to touch on that we didn't yet cover in the episode?
I would definitely say take those risks now, because I can tell you that I regret not taking them earlier, and I regret taking the advice of individuals. And on the stock market note, if you ever hear from anyone that they have not lost money in a trade, they're lying to you. They're lying. Period. I've never missed. Like, yes, I can joke that I had a good first quarter and missed twice, but still missed twice and lost a lot of money, but which weren't fun days. But take things slow in the beginning, absorb the knowledge, because at the end of the day, knowledge is power. And combining that with network of like-minded individuals who are intelligent, who want to lift you higher, and who are going to be there when you're at your low and at the peak is what it's all about.
Definitely. I think take the risks. If that's the message for this episode, take the risks. And we're in the information age, right? Like, it's there, it's available. If someone hasn't told you previously, now you know. So it's up to you. We can only do so much. So if you want to change your situation, or if you want to take a different path, it's definitely available to you, and we highly recommend you go for it. In the show notes down below, I'll have everything linked to Jacob's socials and anything else he wants to throw in there. But thanks for the time, man.
Of course, and I will leave you with one parting note, as this is one of the pieces of advice that actually pivoted my career, was that taking the normal route will set you up for a normal life. Yep,
I like that.
And thank you again for having me, Matt. It's been an absolute pleasure, and it's where I will hand it right back to you.
Yeah. Yep. All right. Thanks, everyone. We'll see you in the next episode. You can stay on, Jake. Thank you to you who made it to the end of the episode. If you enjoyed it, please leave a review on whatever platform you're listening to this on. And if the episode helped you at all, feel free to share it with a friend. It really helps us grow organically and reach more people. Follow us on all social media as well. They're all linked in the description, and I'm pretty active on those daily. Check out our newsletter in the description, Mindshift. Mindshift is a new platform to help us think better. If you are someone who is interested in growing your mindset, learning new techniques, creating unique ideas, and want to excel in your given field, I highly recommend you check it out. It's free after all. That's it for today's episode, and I look forward to seeing you all in the next pod.